Hey everybody, welcome to this webinar. I'm Shane Smolian from Wolftrader Futures, and this is going to be a webinar on whether the S&P is in trouble. I talked about this earlier in the week, but it seems to be coming true now towards the end of the week. We're coming to you live from South Florida here, and we come to you every Saturday at 1 o'clock with a different topic to talk about. I think this week is important, though, to talk about the S&P because I think the S&P is in a situation that is probably going to get a lot worse. So we will talk about that. We're going to loop back a little bit over some information that we talked about last week for new subscribers. If you guys are new to the channel or new to this stream, go ahead and like and subscribe to the video. It really helps us out. And so that will help us continue to get content to you on a weekly time frame. All right, so hopefully the audio and video is okay, and we will get started here. It looks like everything's checking out. So this was the first slide that I had, again, talking about this trouble. If you guys need to get in contact with me, you can always reach me at shane@wolftraderfutures.com or www.wolftraderfutures.com. This is our main website right here. And I have a contact form. You can contact me there, or you can reach us at fedjuice.com. It's the same website. And the YouTube channel, which you're on right now, is Wolftrader Futures. And then the Twitter, the free Twitter feed is at Wolftrader, FUTU1. I highly recommend that you subscribe to this. This is going to be my primary mode of communication. So whether you're a subscriber or not, this is a good method to stay in contact with us. All right, so as we move on here, we have multiple services here that we use for subscribers. So it really depends upon what you want to do or what your focus is on the markets, but we have a lot of content regardless of your outlook. We have the S&P newsletter, which we're going to talk about a little bit more today. We have our metals newsletter, our energy sector, currencies and cryptocurrencies. The symbols covered here. Metals, we're talking about copper, silver, gold, platinum. Energy, we're talking about natural gas, oil, heating oil, and gasoline. Currencies, we're talking about US dollar, Canadian dollar, British pound, euro, Japanese yen, Australian dollar, and euro dollar. Cryptocurrencies, we're talking about Bitcoin, Ethereum, Ripple, and Litecoin, although we are going to be adding more coming soon. We'll probably add Cardano or other ones too. Actually, I'm looking into it, but that's the one that we're looking into right now. We also have the Uranian newsletter, which is an astrology-based newsletter. This is really more for learning about astrology as it relates to people and charts. It's not so much related to trading, but it's a good read if you're interested in that. And then we have the new stock and ETF service here, which is including multiple symbols of popular traded stocks and ETFs. All of this together is our gold package. And then we have the platinum package, which includes trading services, option spreads, fast fed, which is the new big runs that we have now, Easy Timer, Pairs Trader, and then of course you're grandfathered in. So whatever rate you sign up at, that's the rate you're going to stay at for life. That's just how it is. As long as you stay signed up, you get a good rate. So disclaimer, trading commodity futures involves a substantial amount of risk. Past performances are not necessarily indicative of future results. So even if things are working well from 1 month to the next, things can stop working. That's just how it goes sometimes. This is a educational service designed to be a supplement to the book, A Trader's Guide to Financial Astrology, that I wrote with Larry Pesavento a few years ago. And so this is separate from my firm, Trading Ridge Analytics. I'm a registered CTA and CPO with the NFA, and I have a separate firm. So this is different. This is just a newsletter, educational based, and then everybody gets the same data at the same time. Nobody gets signals earlier than other people. Real quick, a warning about using fragments. This is so important because things can change rapidly. So if you hear something this week, it might change Monday or Tuesday, and you might come back next week and say, hey, this was one way last Saturday, and now this Saturday it looks different. That's because the information that I get from the Fed can change. So you get gaps. So just keep that in mind. You got to have the complete picture to really understand what's going on. So just to let you know about that. So terms of service, we never share your personal data. So if you sign up for an email list, I never sell that to anybody. I never buy emails from anybody. If you get an email from me, it's because you signed up for that, and you can unsubscribe at any time. My main focus on the terms of service is that you understand the risk involved. I'm showing you a lot of charts that are working well. These are all real charts. That's another thing too I put in here. These are all real charts that I'm showing you. This is exactly how it went down with our subscribers on Twitter. This is all in a timeline. This is all time-stamped. Everything that I'm showing you has come to pass for subscribers. So this is all documented charts. Okay, so none of these charts are written after the fact or back tested. This is what happened for subscribers. So I just want you to know that we never put up charts that are just hypothetical charts that have not been through the process. Okay, these are actual charts that have happened for subscribers. All right, so news and events. Today's 9/11. Can you believe it's been 20 years? That's crazy since the 9/11 attacks. Today is, obviously it's on a Saturday, but they're performing many services to commemorate the fallen in New York. So it's crazy to think about that, and to think about that we're just getting out of Afghanistan now. So that's kind of crazy. But anyway, so let me go through the news and events here. And we're going to talk about the ETF service. ETF service is up and running and doing very well, guys. This is every week we're adding more material. We've added the lunar cycles. We've added the 4 to 6 day cycles. This service looks solid. I mean, solid, solid, solid. And it's only getting better. We are offering it now at a price of $59 a month. That is going to go up in about a month at the end of October. So if you want to jump onto that, now is a good time. I'm just letting you know. You're coming up in about 5 or 6 weeks before we hike the prices on this. So I always start with a low price with a new service as we're learning, but this thing is rolling, and we're getting a lot of good feedback from people. We're getting a lot of good trades off of this. I'm doing option so far. I've been doing an option spread trade a week, which we'll talk about this week. But this is all coming off this stock ETF service, the charts at least. So the vertical spreads are going well. We had another one this week with Caterpillar. That has just been really good. And you'll see on these charts when you line up what happened with the price action versus the charts, it's pretty incredible. Fed use is running at this new higher resolution. Easy timer and is running. And we also have this new fast fed big runs technology. This is now operational. This is something I've been working on to figure out how to get us the big runs back again. So this is running. This is actually in a short trade on the S&P right now. It picked up the short right before the S&P collapsed, and it's almost to the target. So this big run technology is also being used with the easy timer now. So I expect the easy timer to be picking up too. This is running on a 24-hour. Streaming crypto is finally here. Thank God. I've been uploading a lot of this stuff manually every week. I had Bitcoin on the futures, but now we have streaming symbols for everything. So that means that we're going to have Fed use soon on this. So, and it means that the price history is going to be better. So the existing Bitcoin Fed use is going to get even better. Bitcoin has been trading very well on the Fed use in the last 6 weeks or so. Since we upgraded to this new resolution, but I think it's going to get even better now. The September newsletters are available. Check it out. The double lunar cycles are doing very well across the board. So check that out. That's just kind of news and events in terms of what's going on right now. And let's get started here. Let's look at some Fed internals here. So the focus of this webinar today is going to be more on the S&P 500. I am going to overlap some of the concepts that we talked about last week just to give you the picture. But then at the end, I'm going to give you a few more detailed charts about the S&P. For those of you who are subscribers, on the market update video, I will give you very specific turning points and dates in terms of what I think will happen at certain times. This presentation is more for just a broad-based overview of the markets. And, you know, this is not to give you specific dates or turning points, but just to give you the big picture, give you broad-based focus here. So these are the Fed internals, and I've talked about this, that these things can be falling for weeks at a time or months before the S&P can respond. It's happened before. This is the chart that I always show. This is the 2011. This is 2012. So these are the Fed internals here. So these things, once they start pulling back, the market will eventually pull back with it, but sometimes there's a lag. You can see here there was a 1 month lag here. In 2012, when the Fed starts to pull back here, there was about a 1.5 month lag. So it's not out of the picture that we would have to have this waiting period for this to happen, but it always happens. And so this is why I was talking about the S&P being in such a dangerous situation. This is a picture of the current Fed internals on the S&P. You can see here that we are in a very sharp decline right now on these Fed internals. And this to me, this is a big warning flag. I've been talking about this since July, but we're finally starting to see it now show up in the markets. This is the most recent declines that we've seen here. And every time that we've got this pullback, it's just been pretty much like clockwork. The market does respond. Sometimes it does take a while. Back in the 2018, the taper tantrum, it took 6 months, but eventually it did show up here. The market went into a decline and a stall. And then over here in COVID, there was a 3-month lag right before the election. And then eventually we had the stall, and then the Fed starts to turn up again. But look what they've been doing. They've been pulling back since July. And then this week, the ECB announces that they're going to start pulling back too. And that's when we started to get the selling. So here is 2-month lag here. So it's not unreasonable that it took this long, but it's going to, this comes to pass every single time. So this is why I've been hammering this bearish drum for so long. Those of you who know me know that I'm typically pretty bullish on this market most of the time when I see the Fed synchronized with the S&P, but the Fed has not been synchronized with the S&P. And so that is what we follow. That's how we do it here. We follow the Fed. That's the whole focus of what we do in terms of broader based market forecasts. So I'm really just focusing on the data and the numbers coming across the screen. And when the Fed starts to pull back, that's when we start to get the issues. All right, so let's talk about the fast Fed big runs. This is a new upgraded version of the fast Fed to focus on big runs in the markets, and this is going to be available. This is available for the S&P and also gold. We are going to be adding more symbols too as we go. So, okay, so let's talk about this. So this is the current trade that it's in. So this thing goes short at 4,500 right here. This is the short entry here on the big runs. And again, these are documented trades. This is what happened. This is posted. This is all documented stuff. This goes short at 4,575. And so the target down here is going to be 44.3350. I thought it might have a chance to get there on Friday near the close, but didn't quite get there. We closed at this 44.51. This was the close on Friday. I take a 4 o'clock close when I optimize this, or 1600, however you want to do it, military time. This is Eastern time. So I think we have a good chance to get down to this level Sunday night or Monday. So we'll see what happens. But we're off to a really good start with this. And so this is off and running. So this is available now with the Platinum service. And we're also going to have gold on this. I'm also looking to add more symbols soon. So now that I've got the algorithm in place, I've got all the optimizations done, months and months and months and months of work on this to get this right. This is now finally going to be moving forward with adding more symbols here. We've kind of been in this stagnant period where it's just been kind of stagnant. But now I think we're going to be seeing these big runs again. So that's out. That's available on the Platinum service. So let me talk about Apple. So this is a play from the ETF service. So for those of you who are members of the ETF service, the stock ETF service, this is going to be an example of how you could have used the charts to see this play on Apple coming. Now, Apple obviously had that bad news about the in-app gaming purchases, and so they took a hit. But if you take a look at this chart here, you could see this coming ahead of time. So this is the double lunar here. Here, this is the Fed juice here. I'm doing this out of order here. This is the Fed juice. And this is the 4 to 6 day cycle. So what happens is on these letters here, this letter up here is A. This is Apple. As you can see, it had this big decline. Now the Fed juice had been in a sell on this since 9/1. So 9/1 it goes into a sell. But if you look down here, this is the double lunar cycle. This was already telling you that it was declining. And if you go down here, the 4 to 6 day cycle was already telling you it was declining. So even when Apple was looking like it was trying to break up here, you knew if you had the stock and ETF service, you already knew that the lunar cycles were falling. So you have this advantage over everybody else in the market. So this is a big, big deal, guys. You can visually see these patterns or these divergences coming ahead of time. Okay, so all of this is patterned ahead of time. It's all done ahead of time. You'll know what these cycles are ahead of time, and it projects out into the future. Okay, so if you're a member, you will see these projected out. So I'll show you what I'm talking about. So this is actually, if you take this here, you can see how it projects out into the future like this. So this is a bona fide cycle that's overlaid on top of the chart, and it's smoking hot. I mean, it's smoking hot on pretty much every ETF. It is really good, and we use this to trade the spreads this week on Caterpillar. I also use that with the statistics, which I'll get into, but this is just an example that you could have seen this coming ahead of time. You could have had this knowledge ahead of time if you're a member of the stock and ETF service. So this is why I'm saying, if you want to get into this service, try it now, because the price is going to go up in October. $59 is a very, very low price for this per month, and I feel like we're at a place now where this is going to jump up in price. So just to let you know, and I'm going to show you examples every week just to show you how well this is working. But all of this information was posted ahead of time. Everybody knew that the cycle was falling on Apple. Everybody knew that the Fed juice was down on Apple if you were a member of this service. So, I mean, this is really, really hot stuff, guys, in terms of being able to see major trend changes ahead of time. All right, so let's talk about Caterpillar. This was a play that I made this week on the actual the stock Caterpillar. So we looked at all of the different levels and lined everything up to try to figure out what's the best bear call spread to play, because I felt very bearish on the S&P. So I'm looking to do bear call spreads because I'm expecting this market to continue to decline. So I want to be on the short side, but I don't just want to jump in. I don't want to just look for implied volatilities that are good. I want to look at the odds and statistics that are lining up for us. So that's the idea. So this was for the week of 9/10. These have weekly option chains. So one of the reasons why I picked these signals or symbols for you guys is that I want you to have an option play every week. So we're using these big stocks, liquid stocks that have very highly movable liquid option chains and that expire weekly, because we want to take advantage of about 4 to 5 day moves on these stocks. So this is the play that we made. We sold the 215 call. We bought the 217.5 call that established a credit. And so this happened on Tuesday at the open. Monday was closed for Labor Day, obviously. This had an 88% chance roughly of success, depending on what the delta was. We aligned all of these different indicators, the best RSI, the daily statistics, the Fed use, the double lunar, the 4 to 6 day cycle, and we collected the full premium on Friday. So we didn't even have to buy it back. It just expired out of the money. It was so far down. This one wasn't even close. The Tesla play last week was a little closer, but this one just kept going down all week as it was supposed to. So what do we do when we look at a chart? How do we know that this was the play to do? Well, let me show you the chart here. This is Caterpillar, and we're going to look at one thing at a time here. Well, let's look over here first. This is the daily statistics on Caterpillar. So the first thing that I like to do is I give everybody a statistical view of how this looks, okay, on a daily basis. So for example, Monday last week was the strongest statistical day for Caterpillar, right? So that was Labor Day. The markets closed Labor Day. So what I was looking to do was Tuesday at the open, I was looking to establish my bear call spread. Okay, so because I know that I want to wait till Monday's over because that's the strongest statistical day of the week. Okay, then we get into Tuesday, Wednesday, Thursday, and Friday are the 2 weakest days for Caterpillar. If you want to know the actual statistics, we have that too. You can get this when you're a member, you get to see all of the statistics. So if you look at these percent chances of Caterpillar being up, and again, this was last week, it changes each week. So each week I give you new statistics, but you can see Monday had a 63% chance of being up. That's the strongest day for Caterpillar. And then each day it gets weaker. So you had Tuesday was 46% chance up. Wednesday was 61. So that's almost as strong as Monday. And then Thursday and Friday, look at this, 38%. There's only a 30% chance that Caterpillar goes up on Fridays. So that's the play we were looking at. So that's the first thing I look at. I want to see a statistical profile that starts strong and then gets weaker as the week goes on. That's the whole concept, right? But that's just the first step. So we got to go over here. We got to look at what's going on with the Fed use. Well, the Fed use was in the sell since 831. So Fed use is in a sell, so that's the first check mark. The next check mark here is I'm looking here at the double lunar cycle and the 4 to 6 day cycle. Both of these in C and D were at a high. You see how this is at a high and this is declining? So I know right away, look, I've got the statistical moves over here. I've got the Fed use in the sell here. I've got the double lunar cycle decreasing here. I've got the 4 to 6 day cycle decreasing here. And we had the best RSI decreasing here. So this is why I felt like this was the play of the week for Caterpillar. So we open up this spread right here at the open, and it just fell all week. We didn't even, like, this was the level that it needed to stay below. This was the 217.5. This was the range here. If it hits here, then it's full loss on that. But we didn't even have to worry about it. It essentially just followed the plan as it was supposed to do. So this is what I'm talking about when I say, let's put all of these statistics and let's put all of the odds in our favor. And then that's the way to go. Not so much just looking for a high implied volatility. Let's look for a stock that's not so crazy like Caterpillar. Like Tesla's a little bit crazy because Elon Musk comes out with all those tweets. Let's not look at stocks that have huge gaps all the time. Let's just look at kind of a gentle rolling boring stock that has a really good statistical setup here. And that's what we had here. So you guys can have all this information too with the stock and ETF service. I'm telling you, this is really good information. This is what I use. I use this and I tweet it out to the platinum subscribers. Hey, this is what I'm doing in terms of the spreads. But you don't have to do. So you can do whatever you want to do. I mean, you can buy the stock, sell a stock. You can buy calls, sell. You can buy calls, buy puts, whatever you want to do. You don't have to do spreads. I'm just telling you that this is just one way that you can use this information. So really, really powerful stuff. And so we move down here to the next slide. What I'm going to do is I'm going to show you a little bit of the Greeks here. I'm not going to get too much into it, but this was what it actually looked like. So this was the September 10th option chain. This was Tuesday. So I told you Tuesday I looked to open that spread at 9:35 a.m. Because that was the day after Monday. It just opened up. And so here it is. So your delta is over here. The delta is 12. So that's 0.12. This is your percent chance of closing in the money. Basically, what we want to do is stay below that because it's a bear call spread. So if this is 0.2, that's 12% chance it's going to close in the money, or that's an 88% chance of success. So right off the bat, without doing any work with the charts in terms of lining up all of these indicators and statistics and cycles, we had an 88% chance based upon a random market outcome. But then we put all those odds in our favor to really help us out with that. So this turned out to be a good play this week. This was the gamma, the theta, the delta. The theta was about 16 cents a day on this particular call, and of course that accelerates as you get towards the Friday. But I like these because they're short plays. They're like 4 to 5 day plays, and we're catching that theta when it's in its maximum decay. So it's just a really interesting way to do this. And again, you can do whatever you want. I'm just showing you what I did this week. This is the idea here. So that's what went on with that. All right, so let's talk about some fundamental concerns. So there are some fundamental concerns out there with this market, and I talked about this before last week, that we had a lot of issues coming on with the economy. So I'll go through some slides here just to highlight some headlines. Of course, we had the vaccine stuff going on all week where they're ordering companies above 100 employees to give vaccines, and that could cause additional labor shortages too, because some people are quitting, and there's just all this stuff going on right now. It's all this chaos. But the jobs market already came out with a bad number, so I don't think that's going to help coming down the line in terms of the jobs readings. But the Dow falls 270 points to end the week, falling 5 straight days. The profile that the S&P is making right now is what I call the marching soldiers. This shows up before market crashes. This is a signature, and this is happening before the real negative stuff happens. In order for you to get a market crash, you need the S&P to start selling off ahead of time before it gets bad with the cycles and the astrological phenomenon, all that stuff that's coming at the end of the month. We have that situation set up right now. And I warned everybody, I said, when this thing turns, it's going to turn. It doesn't matter if there's any short-term positive cycles, it's going to go. Okay, so we're in a situation now where this S&P is on the path, at least it's starting to be on the path to have a major correction coming here. So, and again, you guys know that I've been super bullish. I was bullish at the lows. I tweeted it at the March lows of 2020. I will tell you if I'm bullish. I'm telling you right now, I'm very bearish on this market, okay? This is not a good look for the S&P right now in terms of what's going on. Now, in terms of the ECB, Lagarde basically said they're going to taper, and then she came out when the market's crashing. She's like, well, we're not tapering. Well, they really are. They're pulling back on the purchases now. And Europe was one of the things that was helping keep this up. Europe, ECB, or the ECB, US Fed, and the IMF. Okay, so now they're both pulling back. Could be from inflationary pressures. I don't know. Maybe they feel like it's time that they've done enough at this cycle to let things come back. But I'm seeing all of these commodities at a peak. So maybe they see that too. I talked about the consumer sentiment number. It's at the lowest reading since 2011, even lower than COVID now. The private payrolls missed last week. We know that. We are at a worse outbreak situation than we were last year. The jobs report came in at 1/3 of the expected reading. So this is a problem. And what's going on with this vaccine stuff right now, with all of this mandating, and people are going to quit. So I don't know, if they can fill those jobs faster than the people can quit, but it's not good for the labor market, at least in the short term, because it's going to cause a lot of chaos. Now, some people felt like the bad jobs number was good for the Fed, but I knew this wasn't the case because I'm following what's happening with the Fed. Okay, I'm watching the Fed pull back since July, so I know the Fed doesn't really care right now. That I think they feel like the inflation's probably getting a little bit too high in the public's eye, so they're stepping back a little bit here. This is the weekly leading growth index rate. So we're now back to where we were in October of 2020. This is from ECRI, Economic Cycles Research Institute. They post this weekly. They post their weekly leading index. But this economy has basically been declining since March. And if you draw a line all the way across here, we're at the same level that we were in October of 2020. So this is not a good look from an economic standpoint, from a fundamental standpoint. Pretty much however you look at this, the only exception I would say is the housing market, which is still really strong. But we know the Fed owns about 1/3 of the mortgage-backed securities, and the housing market is always slow to respond. And we have a lot more corporate involvement in the housing market now. So I would say that's still looking pretty good. Although there are some signs of slight weakening, but it's still solid. But anyway, that's my point, is that there's a lot going on here. And then we also have the debt ceiling that Yellen told Congress. She was like, listen, man, you better get this in line. She told them, she's like, I can't keep doing this forever. You guys have to vote on this. And we're coming up into that retrograde Mercury, which is always when these debt ceilings tend to go up. I don't know what's the deal with that. I guess it's because they're waiting till the last second, but they always wait until a retrograde Mercury to do that. So the negative divergences, we talked about this last week, but the negative divergences are so important because it's telling us that across the board, multiple markets are in decline in terms of the divergences. So I have this normalized, price normalized MACD. A MACD is something that everybody knows of. It's called a moving average convergent divergent. But this is one that I've developed to find support and resistance and divergences. And the reason it's normalized is because I want to be able to compare a price. If something has tripled in price, I still want to be able to compare it to the past. So it's kind of like a stochastic, but not really, because the stochastic can never go past 100%. This one can. So this one can identify trends. This one can identify divergences. Whereas the stochastic, when it goes up and it hits that roof, it can't go up any higher. So I know some of you may have seen this last week, but I do want to go over this very quickly. This is the euro here. This is the daily of the euro. So this is bumping up and crossing down above resistance levels here. So this is the chart here. If you look at this chart, A, B, C, D, E, these represent peaks in the euro. So how do you know when the euro is peaking? Well, if you go down here to the normalized price adjusted MACD, every time it hits this resistance level here, it tends to turn. So you see how it comes back up to this level right here? Every time it comes back up, so when it comes up here, it turns here, the market turns here. When it comes up and it turns down here, the market turns down here. When it comes up and C, it turns down here, it turns down here. When it comes down to D, it turns down, it turns down, and so on. So we're turning down again. So we're just turning down at one of those levels. So to me, that's telling me that this is not good for the euro. But we're seeing this across the board. We're seeing this on multiple securities. The US dollar's in a negative divergence right now. That's a continued theme that's going on. Gasoline is in a negative divergence right now. So across the board with commodities, with the exception of natural gas, which I will get into, natural gas on a weekly time frame is a contrary indicator to the S&P 500. I'm going to get into that. I think that's more of what's going on right now. I think the S&P is about to collapse, and I think natural gas is picking up because of that. Although we are coming into the winter season, I know that there's a demand thing going on with natural gas, but I think that has to do with the S&P. So gasoline here, you can see that even though we made a new high on gasoline, that this divergence is going down like this. So not good. And by the way, it did pick up a positive divergence during COVID down here from C to D. You can see here, there was a positive divergence here, and it picks this up, but that's over now. All right, so gold, same thing, negative divergence going on here. Gold's been rising on this price, but it turned lower now off of this normalized MACD. Not good. Now this next one is interesting. This is Bitcoin. I know this is before the El Salvador news. El Salvador adopts Bitcoin as their legal currency. And when that happened, it collapsed. So I was talking about this last week, that this was in a negative divergence before that news came out. And so I'm still pretty bearish on the Bitcoin on the short term too. Bitcoin's coming up to some very important turning dates here. So if you're a member of the crypto service, I'm outlining that very clearly in the market update, the dates to watch for a bigger decline in Bitcoin. I think everything's in trouble here across the board. I can't see any asset class right now, except for maybe natural gas, that looks safe. Ethereum right now, same concept, had this big negative divergence down here, and they all got whacked with that El Salvador news. So here was this recent hook up here, and you had this negative divergence coming down. I think these are all in trouble. We are in a negative seasonal right now for Bitcoin too. Keep that in mind. Or crypto in general, generally a negative seasonal for the next month or so, and I don't think we've seen the worst yet. Cocoa is a similar situation. We've got negative divergences forming. I'm going a little faster through these today because we're going to get to the S&P pretty soon here. But this is the 10-year bond, same concept, massive negative divergence going on here since 2021. And then you can see here, price still going up. And I said before, this one's going to be a little harder to come down because of the Fed, but I'm still just outlining it for you. Euro dollar, same concept. We have a negative divergence forming since 2009 back here on the euro dollar, even though the price is still rising. So the reason I'm going through all of this, last week I was talking about deflation across the board, but this does affect the S&P because I think what you're seeing now is, because you're seeing the Fed basically saying, okay, we're going to start to pull back now, you're going to see across multiple asset classes this deflationary pressure, and it's also going to go into the S&P because the Fed goes directly to the S&P first. That's the first thing that we look at with the Fed. So last week we talked about the concept of the double lunar cycle, and when you line these up together with the Fed juice, that you can get these really nice runs. So this is copper. These are real charts here. These are examples of when the Fed juice goes into a buy followed by a cycle low. You can see this is the double lunar cycle here. when they both go together within a day or two, you tend to get these big runs. You see this? And then when they both turn together, you tend to get the big runs down. And when they both turn up together, you tend to get the big runs up. So there's a window of about 3 days, but when you get a cluster of signals in there, it's really, really good. So that's what we're looking for. So if you're, metals service subscriber, this is what you look for. You're trying to line up when you get two of these signals together, the double lunar cycle with the Fed use, and you tend to get bigger runs when that happens. This is Bitcoin, and I've been talking about Bitcoin here, but this is the cycle low here, back on 729. It goes with the Fed juice here. Now notice the Fed juice is getting much better at modeling Bitcoin. You can see here at 729, 811, pulls back 819. These were actual signals posted, guys. This is actually what went down. This is how it went down. And then you can see here the double high here. Now this was important because this was when Bitcoin basically turned, right? I mean, it had that little run up and collapse, but this has stayed in this cell. It's been pretty steady the whole time. So the Fed juice has been picking this up, and it picked up the decline with the El Salvador thing. It looked, the weekend before the El Salvador news, everything was down on the signals, like the double lunar cycle, the Fed juice, everything was saying down, down, down. And it over the Labor Day weekend, Bitcoin gaps up, right? And it looks like both of them are wrong. And then the El Salvador news comes, and it turned out that they were both correct. So the tricky thing about futures versus stocks, the futures are crazy. Like they can look one way 1 second, and then an hour later they're completely the other way. And so this is why it's good to have a steady hand with the Fed juice and also with these lunar cycles. So just wanted to go into that. And then of course, this is the example that we talked about with Tesla. When you line both of these cycles up together, you tend to get nicer moves too. And I'm going to go back and show you what we talked about with the Caterpillar play here. This is the example with that when you line up the actual double lunar cycle here with the 4 to 6 day cycle here, when you line both of those up together, you tend to get much, much stronger moves. And that's what we did. So I'm just showing you like a practical application of what we did this week versus the theoretical here. Theoretical just being the history of this. These are actually the cycles. And you can see here when this comes into a low, they both come into a low, they both go into a high. So just showing you when you can put many, many factors together, your odds of success can go up. And this was the chart here with Tesla. This was like a week old. Tesla collapsed this week. By the way, the Fed juice was in a sell on Tesla when it collapsed too. So the Fed juice did pick this up this week. All right, so new symbols. These are coming pretty soon here. So we're looking at the VIXY. That's probably coming this week. I'm also looking at PAYX and MSTR. Okay. MSTR is closely tied to Bitcoin. So the short-term volatility, the VIXY, this follows, the Fed juice follows this pretty well. So you can see this was an actual out-of-sample reading for this, and it tracked it very well. So something we're looking into. This will help us also too to understand the S&P, but nothing will help us understand the S&P as good as the Fed. The Fed is the ultimate S&P tool to look at. This is PAYX. I like PAYX. It's got a few gaps at times, but for the most part, it flows pretty nicely. PAYX has been on this decline since the market has been going. And again, this is PAYX. So this is closely tied to the economy too, right? Because they're dealing with companies. So PAYX. So as the Fed juice has been tracking this pretty well here. This is the Fed juice here. And so, this is a relatively stable stock. There was a gap into here. I look for stocks that don't have a lot of gaps. I don't like gaps too much because when you're dealing with spreads and things, it's harder to maneuver. So I'd rather have a calmer looking stock. But for the most part, this is a pretty decent looking stock. So it's on my radar to add. This was MSTR MicroStrategy. This one models the Fed juice beautifully. I'm looking into this one. This has weekly option chains too. This was brought to my attention by a subscriber who follows this. This is the Fed use shorting this here. You can see this is still in this very clean short on the Fed use. And I think this company has very strong ties to Bitcoin. So if Bitcoin's going to collapse, this is going to collapse. So that's interesting that these are tracking each other pretty well. This looks pretty bad. The only thing about this one is there are some gaps into here, which is not ideal for option spread plays. You have to really be far away. But you know, the Fed just was picking this up. So ideally, when you're dealing with spread plays, you want to see stocks that are relatively boring. All right, so oh, there's the agenda. I'm just getting to it now. Okay. S&P 500. So fine, let's talk about the S&P. So I was giving you the backdrop of the S&P in terms of what's going on. So let's first take a look at the US dollar. I think the US dollar is critical because if you have a rising dollar, you're going to have market issues, right? And so what we're seeing on the US dollar is we're seeing that the Fed juice just goes into this buy here on Friday. Okay, so this is crossing up now. That is an ominous sign for the S&P. That's not good for the S&P. And then the double lunar cycle goes back into a buy on 9/14, and it's going to stay there for a while. Okay, and then you have a solar cycle here rising on the dollar. So this is going to create headwinds for pretty much everything priced in dollars, but particularly it's going to create headwinds for gold, S&P. So if the dollar starts to get really strong into here, that could be where people go if people get scared in terms of what's going on. So that's the first chart that I look at and I say, oh, this is getting interesting here for sure. So that's the first chart. Going down here. Next chart here. This is the weekly Fed internals. And so I talked to you about this before, but the S&P has never escaped this in the past. So when the Fed does start to do this, when they start to pull back, it tends to show up. So again, here it is showing up here, here it is showing up here, and then we have a period now where it's probably going to show up here, at least a stall, but it can be much more. If they don't turn it back up and they keep letting this fall, the S&P could be in for a serious correction here. So I'm really just watching what the Fed does. So far, they don't seem concerned at all about this. And so if they're going to let it fall, it can fall. It can fall a lot quickly. And then one thing is too that when you have record leverage like we see now, the margin calls come early. They don't have to, you know, in a normal market, you have to have a significant decline before people start to liquidate. When you have everything maxed out, these margin calls can come quickly. So you got to understand that this is not a normal situation because we're so over leveraged. So the selling can start early and the selling can accelerate very fast on this. So understand that this is not normal in terms of when you think about margin calls. We do have option expiration coming up, the third week coming up this Friday. So this is a critical week. I said if it starts to sell off early this week, then that's a really negative sign for the coming weeks ahead, and that's what's happening. Another chart here I want to go to. This is the Astro inversion model. So I talked about this a while ago, but this goes into the sell on 726 and it never went back into a buy. This whole time that the S&P was floating around here, this stays into the sell signal the whole time. It never changed. So there was many ways to look at this, where many indicators looked at this and said, I don't like this rally. This is just one of them. This said this is not a good look for the S&P. So that never changed. All right, next chart I'm going to show you. This is a really, really important chart. Okay, so this is the S&P priced in terms of natural gas. And why do I show you this chart? Well, aside from the Fed, this is the most important chart for the S&P. Why is this the most important chart? Well, first of all, this is a weekly time frame. Okay, so we're going to go through this a little slowly here just to show you what's going on. But this is the S&P priced in terms of natural gas. On a weekly time frame, this is the best predictive forecast that I have. Better than the Fed in some ways. You can go back here to 2020 during COVID. It goes into the sell signal here during COVID. Okay, I'm pricing this. So this is the S&P priced in dollars here. This is S&P in terms of dollars. This is the S&P terms price in terms of natural gas. Okay, so this goes into the sell. This goes into this buy on 410 during COVID, and then it goes through a series here. Notice it goes into the sell here on 8.7, 9.18 it goes into a buy, 10.23 goes into a sell, and then 11.6 it goes back into a buy. 2.5 goes into a sell here, and then a buy on 3.12. Goes up. Now notice this is the one that's interesting. So right here, this goes into a sell on 430.21. This has been in a negative divergence since 430.21. Now, almost all of these trades up to this point have closed in a profit or very break even. This is how far it has to travel just to get back to break even. It has to go to 41.46. So what this is telling me, based upon this chart, based upon this weekly time frame, that S&P is very likely to try to go back to that 41.46 at least, probably more. It all depends on what the Fed's going to do. But if you look down here, this is accelerating to the downside. So the reason is, for whatever reason this occurs, is that the S&P here tends to run opposite to the natural gas on the weekly time frame. So what's happening is natural gas is increasing in price, and the S&P is now telling us it wants to go down this weekly time frame. So this has been in a negative divergence since 430.21. This has nothing to do with the Fed. This has nothing to do with the dollar juice. This has nothing to do with any of these other indicators that I showed you. This is yet another independent way to look at the S&P to tell us on the weekly time frame this thing is in trouble. And it's been in trouble for a long time. And I've been telling people this, but this is another one here. So on the weekly time frame here, this is in trouble. So on the long-term forecast, this is one of the best charts that I have, and it's going down. If you guys have any questions, by the way, go ahead and leave it in the chat section there. I'll be more than happy to answer the questions as we go. If you're new to this live stream today, I'm Shane Smolyan from Wolftrader Futures, coming to you live from sunny South Florida. We are doing a webinar on the S&P 500, whether it's in trouble, and from everything that I can see, the S&P is in trouble. And for those of you who are subscribers, I will give you very specific dates on the market update video tomorrow in terms of what I think the sensitive dates are coming. But on the big picture, this is not a good look. All right, so these are the Fed internals, and I've been warning you guys about this since 7.6. Okay, this is when this goes into the sell. Now notice the S&P was on a trajectory here. It was going higher and faster and faster and higher and faster and faster. Fed shuts this off. S&P initially wobbles, comes down up here, falls down here, goes up here, falling down now. So that line decreased in steepness. So you can see here, even before we had this collapse, it was already it decreased in terms of the intensity when the Fed shuts this down. But we also had the ECB in here. We also had the IMF in here. We had a lot going on. But you can see here that ultimately this is what's going to run the show here. And this is the Fed they're still pulling back. So you might look at this and say, well, you know, look at all these other pullbacks here. The S&P made it back from all of these, right? S&P made it back from here, right? Why isn't this one going to turn around? I'm going to tell you why. Because right here, you still had a surging Fed into here. Right here, you had a Fed that was kind of lateral. Right here, you had a surging Fed into here, right? So this one tries to make it up. This is when you got these wobbling. It comes back down. ECB, still there. IMF makes this big announcement right into here. But this time, what you're seeing intraday, I want to point this out. What you're seeing intraday, you're seeing intraday failures here. This is a very, very different chart looking intraday. So I watch what's going on with the Fed in the day. Usually when the Fed comes in with their operations, with the treasuries, you see these short-term bottoms come in what we're seeing now on the intraday charts is we're seeing failures. We're seeing it's trying to go up, or it goes up in the morning and then it fails. When you see a bear market, one of the hallmarks of a bear market is gaps ups that fail. So we're starting to see that. We saw that a couple of days last week. The intradays look very different, and I think that has something to do with the ECB and the taper, because remember we had that international repo facility. So the banks were linking up, but for whatever reason now, you're starting to see this pullback. I think this is a very different look than we saw, and this is happening ahead of the negative stuff this month, guys. The negative stuff doesn't start happening till the back end of the month or into October. So the fact that this is happening ahead of time, and you're getting these, what I call these marching soldier candlesticks, well, this isn't a candlestick, but you can see these marching soldiers, that can precede crashes for weeks. When you start to see the market just get into this malaise where it's marching and marching lower, and it's failing on these gap ups, and that's what we've been seeing. So this is a very, if you look intraday at this one, this is very, very different right now, what's going on versus what we saw before. And the behavior of the banks is completely different right now, the central banks, than what we saw over here. So this is why I have to tell you, I'm much more bearish right now on the market than I've been in years, okay, in years. So I would just recommend, based upon what the Fed has been doing, I would recommend caution on this. This is a daily view here. You can see that the Fed finally is, the markets are finally starting to roll over with the Fed here. Notice here in August too, this is kind of interesting. I want you to look at this here in August, that there was a point here in August where you can see we're getting this little decline up into here. Notice the Fed had this little spike up into here, and then the markets turn and surge back up into here. But the overall pattern here, they didn't keep going this time. You see that? They didn't keep going. They just turned right back down, right? And so here go the markets again, right back down. So that's important because these markets are very sensitive to what this Fed does. So you can see here, so I'll draw it here. So this was falling down here, and then the Fed starts to surge up here, and then the market hooks back up, but now they're hooking back down, and the main trend is still down on this. So to me, this can be a major problem. It's really up to the Fed in terms of what they want to do. But if they keep this pullback going, you're going to see like problems, like big problems, because this market can't do it on its own. So I've been saying that for a long time. I want you to think about this like if you're at the gym or if you're doing pull-ups and somebody's spotting you, right? You can't lift the weight, but somebody spots you. They help you lift the weight. That's basically what the Fed does with the markets. They're like spotting the markets, right? They're helping them. Like obviously there's natural forces there, but the Fed's there with the helping hand, with the liquidity and all of this going on. So when the spot goes away and you can't lift the weight anymore, you know, it falls on your chest, right? Or you can't do the pull-up anymore, right? So that's basically what's going on. This is a chart here showing really the crux of what's going on here. This is the Fed over here in July. And so this is the big sell signal over here, guys. This is the big problem. And then the planetary speed index went into a sell on 9.9. So you got these two guys. This really comes into play when you have the ability, like when you have a market crash type of a situation, you focus on the planetary speed index because that tends to draw into the emotions of the masses. And we can go back to every single market crash consistently, back to the 20s, back to the 80s, back to 2000s, back to 2008. The planetary speed index is always lined up with the markets falling. There's not one exception. There's not one. And when you get other factors coming in with that, like Mercury stations right around the planetary speed index falling, you can get a really quick acceleration down. We saw that in the flash crash of 2010. Same exact concept. Planetary speed index is falling. Mercury station comes in. We are set up now for a dire situation in this market. Whether that manifests or not is going to depend a lot on what the Fed does. And so this is why I tell you guys, look, I'm watching what the Fed does. But the way that it's looking now, things could get pretty bad. This is a chart here. This is another one. Now this is the dollar juice. This is showing the divergences of the dollar juice. So right here, this is the S&P. You can see this divergence starting in 712. This is measuring the S&P versus the dollar. Here's the negative divergence down here. It's been falling the whole time. And finally, we're getting a little bit of a rollover here. Okay. But this has also been saying, hey, something's wrong here. something's wrong. So I've showed you the Fed juice, I've showed you the natural gas, I've showed you the dollar juice, I've showed you so many charts here, RSI we've gone into before, that all of these are saying the same thing, that this is something is wrong. So let me go into this chart here. I also want to point something out too. This is an indicator here that I developed called the polar R squared, and this is dealing with the R squared, but it's polarized. In other words, it'll rise when the market rises, it'll fall when the market falls. A normal R squared only goes up when a trend establishes. So if the market's falling, the R squared will go up. When it's rising, the R squared will go up. This one actually acts like an indicator where you can find the direction of the market. Every time this has hit zero down into here, the markets have made lows without exception. This has been a very good indicator for the market to basically reverse every single time. But there are times when this indicator it can get down and stay down, when it presses down and it hangs on the bottom like that. And that can be an indicator of a bigger decline. And that's what we're seeing now. This is not the same as previous declines. It's staying down there. We saw this back here, back into February. It was back here. Notice when it first starts to lay on the bottom like that, there was more declines to come in the market. So I just want to point that out too, that that's another warning sign that something bigger could be happening here. So I just want you guys to know that this is not just on terms of what I'm seeing with the Fed. So let's keep going here. All right, so just to summarize here, I'm going to go back very quickly here. For those of you just joining us, we're talking about the S&P 500 and whether or not it's in trouble. So what I'm going to do is I'm going to summarize this, and then I'm going to open up the floor for questions on this. So very quickly, so going back here, US dollar strengthening, the Fed juice is going into a buy, the double optimized lunar cycle is going into a buy. I want you to look at how accurate these double optimized lunar cycles have been on this dollar. This is available in the currency newsletter, but you can see these double optimized lunar cycles here. This is really when it started to get this focused here. But 8.2, 8.3, 8.12, 8.13, 8.25, 9.7. It's got 1 day here where it goes into this wobble, and then 9.14 it goes back into a buy, and it's going to stay there for a while along with the Fed juice. This is pointing to a strengthening US dollar. That's typically negative for pretty much everything priced in dollars, but particularly for the S&P and for gold. Okay. Next slide, just to summarize here on the weekly time frame. Fed internals are falling hard. Every time this has happened, it has showed up in the market. Astro inversion model has been in a sell since 726. It has not changed. It did not like any of this rally. S&P versus natural gas on the weekly time frame, falling. Been in negative divergence since 4/30/21. This is an excellent predictor of the S&P on a weekly time frame. This has been in this sell. Almost every single signal here has made money on this on a weekly time frame. And so if it just goes back to where it started, you're talking about 41.46 on the S&P, probably more than that if it keeps going. This is the S&P price in natural gas here. This is falling. Natural gas is still rising. So this is something to watch here on the weekly time frame. Not good. Fed internals, daily time frame, still falling. The Fed turns this off on 7/6. Market starts to get weaker. Now it's falling. Daily time frame here. Fed internals are falling. Hooking up here, now falling again. Market starting to respond to the downside. S&P Daily Chart here. Fed internals in the sell since 7/6. Planetary Speed Index in a sell on 9/9. Market is started to sell off ahead of the Planetary Speed Index here. That's a negative sign. If this continues, look for increased selling in weeks to come. And then finally here, dollar juice has been in this negative divergence here since 7/12. And this is finally starting to turn lower in terms of the dollar juice. This polar R squared down here tends to be turning points at market lows. Every time this has hit zero, it has reversed. This time it's staying on the bottom, which means this is not the same as other declines. This can often happen at the kickoff of a new trend reversal. Oh, also, let me show you one more thing here that I didn't mention. Okay, so you see these dots right here? This is important here. This is called the BAT. So this is the BAT indicator here. This is the BAT. This stands for breakaway trend. So every time it gets above this, it's in an uptrend. So you can see back here, it breaks into this uptrend back here, and it stays in this uptrend the whole time. Going back here, it goes briefly down into a downtrend here, and then it goes back into this uptrend here. It goes briefly down into a downtrend here. It goes back into this uptrend. It has now broken through this level, and it's on the way down. The reversal point on Friday was 45.23, which is what it has to get to reverse on Friday, but it trails it down. The point is that this is another indicator now that's confirmed the change of trend. I talked about this on like last Tuesday or Wednesday. That started looking like it was changing its trend, but this is now down. So no matter how you look at this, this is not a good situation for the S&P. So I would just advise caution on this. Now, I'm not going to go out and start talking about market crashes and things like that until we get to that point. If we need to get to that point, I will do more frequent updates for subscribers. If I have to post every couple of days, I will in terms of videos. We do post these. We post these signals on a daily basis. So the S&P, you get daily updates in terms of commentary, but in terms of videos, I do videos twice a week, Wednesdays and Sundays. If the market starts crashing, we're going to have to shift gears into some shorter term indicators. And I do have this one indicator that I talked about that I think is really good, which is the fast Fed big runs. This did go short at 4,500. The target is 44.33. So I will be mentioning this if I feel like we need to kind of zoom in and see where this market could be bottoming. But we are at least in the initial stages right now of a market decline. And the initial stages need to have a weak Fed, need to have the markets declining ahead of negative cycles. It's already doing that. And then you have to have a planetary speed index falling, which is starting to happen. And then towards the end of the month, there's a lot of events that are accumulating. So at least we are on the path right now. Again, this all depends upon what the Fed's going to do. But if they continue to do what they're doing right now, the S&P is going to have some issues. Okay, so that's it for this presentation today. If anybody has any questions, go ahead and type it in on the chat now, and I can answer. And let's see, any questions here? Go ahead and ask some questions. All right, so just to summarize here, if you guys want to reach me, you can reach me at shane@wolftraderfutures.com. That's my email. So you can see down here. If you have any questions, go ahead and send me that email. Also on the website, there's a chat you can do. There's a Wix chat. So you can just chat me a question if you have a question. If you want to try one of the newsletters or one of the services, there's a 7-day free trial. Also on the stock and ETF service, if you sign up now, you lock in that rate of $59 a month. That's a very good price. It's going to jump up in October because we've added so many features to this. So if you're just joining us now on the webcast, I advise you to go back and look at all of the setups that we had this week. It is smoking hot in terms of the cycles, in terms of the Fed use. There is a lot of really good information there. So I advise you to check that out. At least check it out. Like I said, you got a 1 week trial, and then you've got that really good rate. You can lock it in. YouTube, you're on Wolftrader Futures. Twitter @Wolftrader FUTU1. That's the free Twitter. A lot of you have been trying to come on to the Wolftrader 1. That's the platinum Wolftrader live streaming during the day. So this is the paid service. This is the free service. So go ahead and sign up to that if you want to get updates. And then, of course, we're on other social media events. So let me just read some questions here. Did I miss it? Which candles on the SPS are identifying as soldiers? Oh, okay. So the pattern that I'm looking at here is the marching lower. The way that this keeps marching lower on the S&P here. So what you start to see ahead of market crashes, and again, it's early to talk about crash, but I'm just saying that the pieces are in place It doesn't mean it's going to happen, but the pieces are in place. It's going to depend on what the Fed is doing. But you see how this starts marching lower here? Same thing here. It's marching lower. It's marching lower. It's marching lower. So what's happening intraday is that this market's, overnight. Let's say the market closes down here. It gaps up and then it starts to fail, or it opens. It tries to rally and then it fails. And so what's happening is you're consistently getting these lower and lower lows on the market, but the way that the price action is going during the day is concerning on that. So that's what I'm talking about then. Now, typically, if you go back to 1987 or even the flash crash, a lot of these, you do see this, or 2011, the summer crash, you do see this price action coming into play before the market actually does capitulate. So we are starting to see that show up now. Okay, so that's one of the things that I'm talking about there. All right, everybody. So we'll go back here one more time. If you need to reach me, you can reach me, Shane, at wolftraderfutures.com or www.wolftraderfutures.com, and I will be looking for any questions. If you like the video, guys, go ahead and give it a thumbs up. Subscribe to the channel. Let's get those numbers up. Go over to the website. Check out. You can sign up. There's a free member area. You can sign up to get on the email list over there. That's a good way to keep in touch too. And so definitely drop by every Saturday at 1 o'clock. We'll have a different presentation. And if we do get a crash type of a scenario, I will definitely give you a presentation on that. I think we are set up now for that, but we still need to wait for confirmation on that. So we still need to wait a little bit more. But things are set up now, guys. It's very tenuous on this. I just be cautious with this S&P. It doesn't look good. So just be careful out there. All right, guys, you are welcome for the videos. So next weekend, we will be back at 1 o'clock with another theme on the markets. For those of you who are subscribers, look for the market update video tomorrow night. There are many new exciting features coming to many services, to the stock ETF service, the platinum members. We've got all this new stuff coming up. We have the new the Easy Timer Big Runs. We got the 24-hour Easy Timer. There's a lot of really good stuff coming up in the pipeline here. So that's basically it, guys. So thank you, everyone. Thank you, everybody, for stopping by today. I really appreciate it. Thank you very much, and have